This is Nightly Business Report with Tyler Matheson and Susie Garrett.
Economic pressure, stocks knocked down as sanctions against Russia ratchet up. The targets, banks and energy. Hashtag flying high. Twitter shares soar as the social media company posts a surprise profit and says it's adding more users, a lot more. And piling up, the debt problem you may not even know you have. All that and more tonight on Nightly Business Report for Tuesday, July 29th. Good evening, everyone, and welcome. I'm Tyler Matheson. Susie Garrett has the night off. Stocks dropped as the U.S. and European Union, acting in tandem, imposed tough new sanctions against Russia because of its actions in Ukraine. More on that in a moment, but we begin tonight with after-hour earnings that sent one high-profile social media stock zooming. Twitter shares soared after reporting blowout second quarter results. Wall Street expected the company to report a loss of a penny a share, but surprise, surprise, it turned a profit, albeit a small one, 2 cents a share. Revenue, though, more than doubled, and the company saw a big uptick in user growth. And here is what happened to the stock. Look at that chart, up as much as 30% in after-hours trading. Our Julia Borston spoke with the CEO, Dick Costolo, and has a look at what drove those results.
Twitter shares soaring after hours as the company's results beat expectations across the board, and the company raised its full-year guidance. Twitter's users numbers are growing faster than expected. The company ended the quarter with 271 million monthly active users, up from 255 million at the end of last quarter. The company benefited from the World Cup, but in an exclusive interview, CEO Dick Costolo said that's not all.
It was a continuous set of growth across the quarter. It was no one moment or one time a thing that affected the growth in users. It was the combination of product changes that we've talked about over the course of the year that are starting to deliver the kind of results we wanted to see.
When I asked Costolo if Twitter's advertising revenue per user would be able to double to catch up with Facebook's, he said he didn't see anything structural to prevent Twitter from having the same kind of financial results seen from others in the space. And as for catching up with Facebook's size, he said our goal is to have the largest total audience in the world and reach every person in the planet. Fielding questions tweeted in about privacy, Costolo says the company is taking action.
We have a whole product team focused on user safety and privacy, and we'll continue to invest in that as we become increasingly the world's information network. Obviously, it's the case that we need to take that seriously and address it.
Now we'll see if Costolo can keep up that user growth and continue to grow revenue. For Nightly Business Report, I'm Julia Borston in San Francisco.
A major escalation today in the war of words and actions with Russia over what the West says is its continuing role in backing insurgents bent on destabilizing Ukraine. Until now, the mostly U.S. sanctions targeted individuals and were widely regarded as token efforts to make Russia's Vladimir Putin back off. He hasn't. President Obama said the new measures, coordinated with the European Union, are aimed at three key and sensitive areas for Russia: energy, defense, and finance. Future technology sales to Russia's important oil industry will be blocked, matching actions by the EU earlier today. And the president says the sanctions already in place are taking a toll.
Russia's actions in Ukraine and the sanctions that we've already imposed have made a weak Russian economy even weaker. Foreign investors already are increasingly staying away. Even before our actions today, nearly $100 billion in capital was expected to flee Russia. Russia's energy, financial, and defense sectors are feeling the pain.
Let's bring in our Washington correspondent, John Harwood. John, what did the president and the European allies do today specifically? And is it likely to change Vladimir Putin's mind one little bit when he clearly enjoys very strong support within Russia?
Well, obviously, as you indicated earlier, nothing has changed his mind so far. But this was the moment the president was waiting for when finally Germany, Italy, France, the United Kingdom agreed to be willing to bear some of the pain that they would feel from inflicting pain on Russia because they are so much a bigger and economic player with the Russians than the United States. The U.S. had been reluctant to get out front too far because it wasn't going to do all that much as long as Europe continued to do business. It would simply make the United States look weak. So now you have the possibility with these broader sectoral sanctions of changing the calculus for Putin. If it doesn't, then they're going to have to see if there are any other steps that they can take. Everybody's ruled out military boots on the ground. One of the options, of course, Tyler, is supplying the Ukrainian armed forces. But the president said today, when asked about that the problem right now isn't Ukraine's inability to respond militarily. It's something to change Russia's incentives.
He also said, I thought pointedly in response to a question, that this is not the beginning of a new Cold War.
No, he didn't. And, the United States continues to seek Russia's assistance on other issues, such as sanctions against Iran and North Korea and a whole range of other issues. And, they had the reset in relations early in the Obama administration. They say they got some results from that. So they're not swearing off the relationship, but they feel like, given the seriousness of the situation in Ukraine, the violation of Ukraine's sovereignty, and finally the downing of that passenger jet, this is the moment that they can mobilize the European community to join them and maybe change the balance of power in Ukraine.
And very quickly, John, followed by the downing of some other military aircraft after the downing of that Malaysian airliner.
Yes, and also firing of artillery shells into Ukrainian territory from Russia. It hasn't gotten better so far. This is the strongest gambit the West has made yet.
John Harwood, thank you very much. Those sanctions overshadow generally favorable corporate earnings and some new economic reports on the state of the economy. Consumer confidence, as measured by the Conference Board, jumped in July to a nearly 7-year high. But a new report on housing confirmed what we already know, that home price gains are slowing. By the close, the Dow fell more than 70 points and is now about 1% off its record high. The Nasdaq dropped 2 and the S&P 500 was down nearly 9 points. American Express reporting earnings after the bell, posting a 9% jump in profit, partly on higher credit card spending. Earnings were $1.43 a share, exceeding expectations. Card member spending accelerated, also growing by about 9%. Revenue up 5% at Amex, meeting forecasts at $8.66 billion. Some of that came from the sale of half the company's corporate travel business to an investor group. Shares were initially lower after that report, and there you see they closed at $91.71. Two major pharmaceutical companies, both Dow components, posted quarterly profits that beat analyst predictions, but both stocks went in opposite directions as the companies look to find new areas of growth. Meg Terrell has more.
The country's two largest drug makers are gearing up for growth. Both are facing generic competition to major medicines. Merck lost patent exclusivity on prescription nasal spray Nasonex, while Pfizer faces generic competition to Celebrex for arthritis and pain later this year. The two drugs' combined sales, more than $4 billion in 2013.
Both companies are facing a lot of patent losses, and they have a lot of legacy products that are doing pretty well to kind of offset those patent losses, but really translating into pretty stagnant growth. And that really sums up to leading to the question, well, where is growth going to in the future? And I think that's really dependent on the pipeline for both of these companies.
So what's coming up? For Merck, investor attention is on cancer and hepatitis C. It's developing a drug called pembrolizumab that's under consideration at the FDA for treatment of advanced melanoma. But Morningstar's Damian Conover says it could be expanded into other diseases like lung cancer, in a market he estimates to be worth $20 billion by 2023. Merck's also developing a combination of medicines for hepatitis C to shorten treatment times to as little as 4 weeks. That's the same disease targeted by Gilead's Sovaldi, the pill that's drawn attention for its efficacy and controversial price tag. Conover says drug makers' focus on these specialty diseases is only increasing, and that could be good for patients.
As Merck shifts to specialty care, and as do a lot of other big pharmaceutical firms, you're going to see a bigger wave of an influx of specialty care drugs that's going to increase pressure on pharmaceutical firms and biotechnology firms to reduce some of those prices.
As for Pfizer, it's developing a breast cancer drug called palbociclib that could draw $5 billion in peak sales, according to ISI Group. And all eyes will be on Pfizer's plans for business development. Conover expects it will make another bid for UK drug maker AstraZeneca, continuing a string of so-called inversion deals that lower companies' corporate tax rates by moving them overseas.
And in telephone interviews today, the CEOs of both Merck and Pfizer said that U.S. tax code must be reformed. Merck's Ken Frazier said the company's not considering a big consolidation deal, while Pfizer's Ian Reed said the company will consider acquisitions of all sizes. Both CEOs said that U.S. tax code puts companies at a competitive disadvantage. For Nightly Business Report, I'm Meg Terrell.
It was a big earnings miss for UPS, and the outlook wasn't much better. Higher spending and increased costs caused the package delivery company to lower its profit forecast for the year, and that sent shares down by nearly 4%. Morgan Brennan takes a closer look.
The world's largest package delivery company shipped 7% more packages around the globe than a year ago. Shipping activity surged internationally, especially in Europe. But here in the U.S., more consumers purchased products online. E-commerce fueled a 60% increase in UPS's less expensive SurePost shipments. A positive sign for consumer spending, but a drag on the delivery giant's revenue per package.
It is an interesting time. We're seeing actually the strongest growth in our domestic business that we've seen in over a decade. Certainly e-commerce is driving a lot of it. But at the same time, we are making big investments to expand our capacity and be able to handle all this growth. So that's why you are seeing mixed results economically, but great results as far as demand.
Those investments are in response to botched holiday season deliveries last year, after UPS and competitors couldn't keep pace with a last-minute surge in shipping demand. The investments include updates to existing infrastructure, dozens of newly built hubs, and plans to operate this Black Friday as a full workday, the first time the company has ever done so. Altogether, it'll rack up $175 million in costs, significantly higher than the $100 million that UPS initially estimated earlier this year. That spending will weigh more heavily on future earnings through the rest of the year. But analysts say the investments are prudent.
Long run, we think the company will adapt its network size to the challenges of increased demand. And then the greatest contention will be dealing with the long run shift in mix to e-commerce.
Moving forward, analysts say the biggest challenge facing UPS will be catering to increasing shipping demand as new infrastructure is still being built out. Also, whether the dramatic increase in online shopping will continue to pressure sales. For Nightly Business Report, I'm Morgan Brennan.
Still ahead, are Americans getting better at paying down debt? The surprising numbers behind a new report. China is, of course, one of the hottest growth markets for American technology companies, but for Microsoft, relations are quickly turning cold. As we told you yesterday, Chinese officials made an unexpected visit to Microsoft offices, and today things intensified. Eunice Yoon has more now from Beijing.
China has confirmed an investigation into Microsoft. The State Administration for Industry and Commerce has said that the software giant is suspected of a monopoly. The agency cited compatibility issues for the Windows OS and Office software and said about 100 officers raided Microsoft's offices in various cities across China to gather more information into the way Microsoft bundles its software and adds security features. The inspectors are also investigating some of the company's senior management and other personnel in China. The government said that some of the employees in question have been out of contact and is urging Microsoft to cooperate with the authorities. Microsoft had confirmed the official visits on Monday and had said it was happy to answer the government's questions. Microsoft is the latest American tech firm to face scrutiny from Beijing after Washington's repeated accusations of Chinese cyber theft.
For Nightly Business Report, I'm Eunice Yoon in Beijing.
We begin tonight's market focus with strong after the bell results from Amgen. The biotech company saw better than expected earnings helped by strong sales of its rheumatoid arthritis drug. It raised its 2014 guidance, also announced a new restructuring plan, and it's going to cut its workforce by as much as 15% to focus its resources on developing new drugs. It will close 2 of its plants as well. Shares rose initially after the report. During the regular session, the stock was up slightly to $123.31. Aetna posted an earnings beat as the insurer saw record medical membership and revenue. On those good earnings, the company upped its full-year outlook. Despite that, investors were concerned about rising medical costs, which the company blamed on the new hepatitis treatments, hepatitis C that is, and its public exchange memberships. Shares of Aetna down 3.5%, $81.88 the close. Corning, the company best known for making the Gorilla Glass used in Apple and Samsung smartphones, reported a mixed second quarter. Earnings missed the mark as demand for that glass has been lower. On that, the company cut its full-year glass shipment growth forecast, and the stock tumbled. It ended down more than 9% at $20 even. Shares of Caterpillar higher on the news that the heavy equipment maker has agreed to repurchase $2.5 billion worth of its stock. It's going to buy it from Societe Generale. That sent CAT up a fraction to $104.69. And shares of Windstream popped after the telecom company received regulatory approval to convert some of its assets into a real estate investment trust, or a REIT, in an effort to minimize taxes. That approval made other telecom companies look more attractive to investors, and it sent shares of Windstream as well as Frontier, CenturyLink, AT&T, and Verizon all higher. The Federal Reserve has begun its 2-day policy meeting and is all but certain to continue winding down its economic stimulus, part of its great monetary policy experiment following the financial crisis. And for the past 5 years, the Fed has pegged interest rates at 0 and put about $4 trillion worth of extra cash into the banking system and on its balance sheet. So what happens when the central bank tries to bring rates and its balance sheet back to normal? Will it end badly or well? Steve Leisman reports.
The market expects the Federal Reserve to stop buying assets this year and around this time next summer to raise interest rates for the first time since 2009. So what happens then? Can the Fed exit its extremely easy monetary policy smoothly, or will it all end badly? The July CNBC Fed survey finds the market evenly divided between doomsayers and soothsayers. 34% say it will end badly in a recession or a market sell-off or higher inflation. 34% say it could end well, and about a quarter say it could go either way.
Well, I think we've had periods in the past with very low interest rates, very easy monetary policy, and in the past they've ended badly. I think in this particular period, there are even more risks and challenges to what monetary policy has done. And I think the Fed, to pull this off, has got to get too many things just right. I don't think it will get that many things just right.
Bruska thinks inflation will rise, forcing the Fed to raise interest rates to cool down the economy, causing a spike in interest rates, and that could cause stocks to sell off and ultimately result in a recession. But John Lonsky of Moody's Capital Markets disagrees. He's not worried about inflation, at least not until he starts seeing the money the Fed has pumped into the system, called excess reserves, being turned into loans.
Until I begin to see this increase in reserves, this huge balance sheet, produce more in terms of loan growth, chances are it is not going to go ahead and trigger a lasting upturn by inflation.
Both economists agree the Fed will need to tread carefully. Lonsky thinks the Fed can do it, but Bruska says it has to move interest rates from 0 all the way to 4%.
It's like asking me, how can you drop an egg from a 10-story building and have it not break? I don't know. How can you?
The Fed will try and not break any eggs at its meeting tomorrow. It's expected to reduce its bond purchases by $10 billion, bringing them down to $25 billion a month, and could signal those purchases will end in October. Part of the Fed's effort at a smooth exit and to prove wrong those who think it can't end well. For Nightly Business Report, I'm Steve Leisman.
A new study by the Urban Institute finds that more than 35% of Americans with credit records have debts that have been reported to collection agencies. This is even though credit card debt as a percentage of income is at its lowest level in more than a decade. The study found such things as unpaid hospital bills, student debt, even gym memberships are piling up. The delinquent debt is overwhelmingly concentrated in southern and western states. Nevada and Texas have unusually high percentage of households with debts subject to collection actions. So what do you need to know if you're one of those Americans facing debt collection? Tim Maurer joins us now to help put it all into context. He's Director of Personal Finance with BAM Alliance. Tim, always great to see you. Thank you for rejoining us. I thought our debt problems were getting resolved, that total debt was coming down and that these problems had gone away. But it seems like the number of households with debt in collections is stubbornly high, hasn't budged much at all.
Tyler, I think that it may be a result of the crisis that we had in the past with mortgage debt. That was so much bigger and so much more of an issue. That's where all of our focus went at the time. But think about this, and especially when you look at the different geographic areas that are suffering so much, it's some of the areas that were hit the hardest economically in the midst of the downturn of the Great Recession, the credit crunch. And so those folks understandably may have had to defer some bills for money they owed. They may be in denial, but I think it can make some sense as to why we're seeing this today, even though we see overall debt coming down.
Is it, I am sure that most of the people who are subject to collections know that there is a collection action out there outstanding. But my guess also is that there are a fair number of us who have collection actions that we don't even know about because we haven't checked our credit records in a long time, or we've moved and the bill keeps going to the old address, hasn't been forwarded.
Certainly possible, and I do think that there's even some fraudulent activity there. One of the foremost reasons to make sure you're checking your credit report at least annually. But I would say that medical bills is the big one here. Tyler, believe it or not, most foreclosures happen as a result of, in many cases, medical bills. It's one of the top reasons for foreclosures, even in the recent downturn. They tend to be big numbers, and they do tend to be harder to understand exactly how much you owe. You know that the insurance company paid some, and then you have a bill for some. They're coming from doctors, hospitals. I do think that medical bills especially can be particularly perplexing.
How much do these credit actions or collection actions hurt your credit rating? And does a $50 bill hurt you as much as a $500 bill?
Well, look, smaller bills are definitely not going to hurt you as bad as bigger bills, but simply having someone go to collection is certainly one ding against you, and that certainly will have a negative impact. Here again, with your credit card company, they're not likely to send to collections for 6 months, but your doc, the hospital, will automatically outsource the collections to another external company, and as a result, they tend to get to your credit report even faster, Tyler.
That's an interesting point, Tim. It's not necessarily your credit card that's causing the problem here. So is the best thing I can do get a credit report from one of the 3 major agencies or all 3? What do you do? Give me some advice.
Well, I've got to be honest, I check it, I'm a financial planner, so I do it as inexpensively as I can. And there are 3 great free resources that I have used in the past, that I currently use, or that I've recommended and people have gotten good news from. So annualcreditreport.com is one where you can get each of the 3 major credit bureaus to send you the credit report itself. You do have to pay money if you want to get your credit score, but if you go to creditkarma.com or Credit Sesame, there you can get an idea of what your report looks like and also an estimate that tends to be very close to what your credit score is. And as you know, that credit score definitely drives a lot of the purchasing we do with leverage.
Tim, next time you come up here and teach me how to tie a bow tie, okay?
My pleasure.
All right, Tim, thank you very much. Coming up, Uber and Airbnb have already disrupted the transportation and lodging industries, and they're not done yet. What these 2 startups are setting their sights on now. And finally tonight, 2 hot startups, Uber and Airbnb, now moving into the lucrative business market. Josh Lipton tells the story.
Uber already has a lot of fans among consumers. Now the startup is taking aim at business travelers. Today, Uber announced what it calls Uber for Business, letting users bill their trips directly to their company. Within the Uber app, users will be able to toggle between payment options, which means business travel can be automatically expensed while personal trips stay personal. Uber is also partnering with Concur, a travel management service with 25 million people, as well as American Express, whose cardholders will earn double points on Uber rides.
It's about making the experience of using a car for business purposes just better than it already is for both the employee and for the corporate account expense manager.
This is another big growth opportunity for Uber, which is already valued at $18 billion. That's about the size of Hertz and Avis combined. Uber's news follows an announcement from Airbnb, a startup that lets homeowners rent out spare rooms to strangers. Airbnb this week also announced a partnership with Concur and introduced its own service for business. Both startups are trying to cash in on the fast-growing market for business travel, aiming to disrupt global brands such as Hilton and Marriott. The corporate travel industry is expected to generate $1.2 trillion in revenue this year, according to the Global Business Travel Association. One risk for Uber and Airbnb, though, is backlash from politicians and regulators who question the safety and security of these services. That could limit the market share these companies ultimately grab. But Uber's executives say such concerns are unfounded.
We have better insurance coverage than any other ground transportation provider out there today. And so businesses are covered end to end and their employees more so than any other means of transportation today.
Only time will tell whether Uber and Airbnb can have the same success with companies as they do with consumers, but today's announcement is a big shot across the bow at entrenched players in this space. Josh Lipton, Nightly Business Report, Silicon Valley.
And that'll do it for Nightly Business Report for tonight. Thanks for joining us. I'm Tyler Mathisen. Have a great evening, everybody. We'll see you tomorrow. I'm Tyler Mathisen with a Nightly Business Report news brief. Wall Street today, stocks dropped as the U.S. and European Union, acting in tandem, imposed tough new sanctions against Russia because of its actions in Ukraine. The Dow fell more than 70 points. NASDAQ dropped 2, and the S&P 500 was down nearly 9. After the market closed, Twitter's second quarter report beat expectations on both the top and bottom line. The social media company earned 2 cents a share, reversing last quarter's loss. Revenue more than doubled, and the company added 16 million new monthly users. Consumer confidence jumped in July to a nearly 7-year high. And a new study finds that more than a third of Americans, 35% to be precise, has some debt that's past due and is in collections. Be sure to tune in to Nightly Business Report here on your public television station.